This is our Forex blog for June 14th, 2012, and as you can see, I have the Build Your Own Currency Meter running. This is a live-only tool. It shows you the statistical strength or weakness of each currency compared to all the rest of them on multiple time frames using multiple different tools. Some of the tools that's made up of the histogram on top, we use 5 different ones. 3 of them measure the direction. In this case, the yen's moving versus the rest, and 2 of them are the intensity. So anytime you have a currency that's going up or down versus the majority of the other pairs and doing so with incredible intensity, obviously the trend is much more likely to continue. Underneath that, we have the 15-minute trend, hourly trend, daily, weekly, and monthly. The more time frame trends that line up, the better. I pretty much ignore the monthly trend. I do care about the weekly. If I see some weakness come back in, like later today, and the weekly trend's down, I'm going to take that trade. Daily trend switches also down a little bit later, around 10. Anytime you have a currency that's strong on all time frames, like the New Zealand, it's pretty much a no-brainer. You want to buy the New Zealand versus one of the weaker pairs today, such as the dollar. Also, the new currency meter allows you to sort the quote sheet. If you link them to the charts, you can put the strongest or weakest ones on the top or bottom, and now you can see the New Zealand, Australian, and Swiss are going up against 100%, 85%, and 71% of other pairs. The dollar and yen are the weakest ones. Pound, second weakest. So basically, it makes it a lot easier. You want to focus on buying the strongest ones versus the weak, and selling the weakest versus the strong. We have a 3-step easy Forex trading system, which I'll go over the rules real quick right now. And step 1 is to use the currency meter or quote sheet or hot list and focus on buying the strongest currencies versus the weak and selling the weakest versus the strong. Step 2, wait. Too many traders are impatient. They sit down, they want to get in the trade right away within 5 or 10 minutes. Sometimes you don't find a good trade for 20, 30 minutes or an hour. Some days, it's very hard for me to do, but there's some days I've sat down for an hour and a half not taking one trade because, it wasn't worth risking your money. Your goal as a trader is to make money, but the first and obviously the most common sense thing to do is to not lose money. If you are not digging yourself out of a hole, when you do have a profitable trade, it goes in your pocket. So wait for good trades, and then when the strongest currencies that you're watching have a buy signal, that we have put in the new code that looks for certain range bar patterns that have buy signals, when price goes 1 pip above that bar's high, you buy. Or if the price is near a support or resistance area and you don't think it's going to go that much, you might want to pass on the trade. You can also wait for the trailing stop to get hit and flip down below price and turn green, then buy. So the exact opposite rules for sells. Look for the weakest ones to sell, wait for a sell signal, and when price goes 1 pip underneath the bar's low, you sell. Or you can wait for the trailing stop to get hit and flip. That gets rid of some unnecessary losing trades. It's like any form of insurance, it has a price. Usually you pay 3 to 7 pips more or less, worse price for the entry. In other words, instead of buying 1.2300, you might be buying 1.2305 when this occurs. If you really believe in the trade or it's had a deep enough pullback, you probably want to buy it or sell it when it goes 1 pip above or below the bar's high or low. If the market hasn't pulled back that much, you might want to wait for the trailing stop to get it. So sometimes I do wait for trailing stops to get triggered before I get in. Most of the time I buy when it goes 1 pip above or 1 pip below the previous bar's high or low. Then for exits, inexperienced or traders for small accounts, $25,000 to $50,000 or less, should use trailing stops for all your exits. The bigger the lots you trade, the more a little bit higher stress you have when trading. So I find it psychologically easier to exit half my trade when it hits the first Fibonacci Profit Target or any level of support resistance. I list the ones here in order that I find them most important. So when you exit half of the trade, you either exit the second half of the trade when the trailing stop gets hit, or keep in mind that the 1.618 fib target usually is the maximum profit, and almost all the time the 2.0 fib level is. Now, you could draw a fib level on a 10 pip swing, and the Fibonacci Profit Targets are worthless. Fibonacci Profit Targets should be drawn on swings of 25 to 50 pips. The bigger the move, the more likely the 1.618 is to hold. If you have a 30 pip swing, then it's possible it could hit the 2.0 level. It's not likely to go beyond that without pulling back or going sideways first. So let's look at some of our trades today. We know that the New Zealand's strong, and the dollar, especially after 5:30, was weak on all time frames except the monthly. This is a perfect example of why I've kind of ignored the monthly. It's all up on the New Zealand, and for the most part, all down except the monthly. Monthlies can take 3 days to 2 weeks to change direction, so it doesn't matter. We're intraday traders. We're looking where's it going to go in the next half hour to 2 or 3 hours maximum. So we want to bring up the New Zealand dollar, and here's the range bar chart. First of all, here's the previous day's high, the dotted green line right here. It's above yesterday's pivot, breaks out right here. You have a buy signal. Once it breaks out above here, you might have went long right when it broke above the previous day's high, and you got stopped out with a loss. You have another entry right here. When it goes 1 pip above that bar's high, you get in, use the trailing stop to get out, or like I said before, you draw your fibs. A fib on a tiny range like this, you can see the number there right next to the fib is 34 pip. It's a 34 pip swing. See that as I bring it up? 40 pips, 50 pips, see that? To the right of where the current price is. So this is a 29 pip move. The 1.618 is more likely to get hit because it is such a tiny move. You want to get out of half your trade here, and then the second half when it hits the trailing stop. And notice how strong it was going up. When you see incredible strength like that, look for the weakness on the way down. I like to see at minimum 15 pip pullback. So we have a few buy signals right here. 15 pip pullback is somewhere around here. So at that point, I would be waiting for it to go above those bars high to get in. Comes down again, you might want to get in here if you really believe in the trade at 84, or wait for the trailing stop to get hit 89. Like I said, 5 pip, worst price entry, but it's like a form of insurance. If you had bought this one or this one, you have a loss or two. You wait for the trailing stop, you wait for a decent sized pullback, you're much more likely to get a higher probability trade. Also, once it makes a higher high right here, redraw your fibs off of this. And a 50% pullback is usually a good place to get in to a trade. You can get in right here with your stop underneath here, the stop underneath the 62% retracement, which is also the yesterday's high. Very strong area of support. Anytime you have two strong levels of support right next to each other, you can buy knowing that if it does break this, more than likely it's going to come down even further. So you're in that trade here, and once it starts going your way, you want to redraw your fibs off the last wave. Here's the low of that last move. And again, Fibonacci profit target. This one had gone up, sideways, up a little bit, sideways, up a little bit, pullback, sideways. So it's gone up many times. It's more likely to stall out at the fib target right here. We got a 32 pip move. You waited for a pullback. Let's say you bought it at 90. That's 17. It's 27 pips away. That's almost the distance of this from the pullback area. So seeing how many pips the previous swing was gives you a good potential profit target. And as it's going up, if you see a lot of strength coming in, hang on, wait for the fib target. You can see when it hit that fib target, it had less strength than it did before. You want to get out of your whole trade right here around 17. You made 27 pips on that trade. The key to trading is small losses, big wins. Now the yen wasn't as weak as the dollar, but the New Zealand was incredibly strong. It was the #1 strongest currency on all time frames. So the New Zealand dollar is also likely to go up. You can see this one, the real-time trend pretty much shifted to the upside around 6:30 right here. You have a very choppy price action. You always want to wait when you see a choppy move like this for it to break out and make a higher high. Then usually buying the next pullback works. This one probably wasn't quite strong enough to have any buy signals on there until right here. If you did buy this one right here, notice the upper containment bands where it usually reverses. You could take a stab at it right here because this is the previous week's high. That's why it had trouble getting above it. The third time it broke through it, it's very much likely to go. You buy it right here with your stop 1 pip underneath the low. You want to risk as little amount as possible because of how choppy it was all day. And normally I don't like to swing this big, but it was very tiny all day. You don't have any other Fibonacci areas to draw with. And when it gets up here, you get out. Now, if you drew your fibs on here before you took the trade, this is one of those things where you probably wouldn't take the trade. I like to take trades that are likely to give me 2 or 3 times bigger profit than my risk. And that way I don't even have to worry about being 50% or 70%, 80%. New traders are incorrectly focusing on winning percentage. Winning percentage is bullshit. It doesn't mean anything. I'd rather make money. If you have a 40 pip win and then lose 3 times in a row, 5 pip loss, break even, 3 pip loss, 8 pip loss, and you left with 20 pips at the end of the day, even though you had 1 out of 4 trades that worked, you're 25% winning, but you made money. I've seen traders that take 3 pip wins over and over and over again and then have 50 and 80 and 100 pip losses. And guess what? They wipe their accounts out, they lose all their money. So would you rather be a 80 or 100% or 80 or 90% winning trader with no money in your account, or make money trading? Some days you're going to have high winning percentage, and some days it's going to be horrible. But if you keep your losses small and you focus on the currencies that are moving, like the New Zealand dollar, 10, 15 pip move, 27 pip move, right? That's 37 pips on those 2 trades. If you took another 10 pip loss, right, now you're down to 27 pips. If you take another 10 pip loss, you're down to 17 pips on the day, and you're only 50-50. Guess what? If you took another loss, 2 wins, 3 losses, right, you're down to 7 pips. But you made 7 pips on the day, even though you only made 2 out of 5 trades. You were only 40% accurate. So again, our easy 3-step system: focus on the currencies that are most moving using our currency meter, and then wait for signals and take those trades. Now, the third weakest one later in the day was the pound. The New Zealand was really strong. This is not a currency I typically watch most of the time, but let's just take a look at it. Pound New Zealand. I'll put 2 days on here. We'll have this is probably a little bit more volatile. We use 6 pips per bar, and we'll see how it did. We'll put this on range 7 right here, layer 7. It's got to download a lot of tick data, and it will create the range bars, and we'll put our signals on and see how the sell signals worked. All right, so this one is a trending down. Weak pound, strong New Zealand. We're going to go to add script and go to FX trade signals. For whatever reason, I can never find it fast. All right, it's going to download a lot of data, calculate the signals based on range bar patterns. And we don't have our real-time momentum tools on there, but So all right, so here this is telling you to short. Anytime you have a move that's down like this, always draw your fibs. I like to get short at the 50% level. You could have gotten short right here. You can see it went down a little bit. This is not much of a pullback, and I kind of skipped those. But if you have the real-time momentum tools on here and all the time frames are down, you might take the trade. You can always take smaller lot trades on riskier trades and bigger lot trades after a deeper pullback. And that way, when you get a big win on the higher probability trade, you have more lots and obviously much bigger profit. Notice how it really stalled at the 1.618. And like I said at the beginning in the rules, rarely do markets ever go beyond the 2.0 level. This one went 2 pips beyond that and then shot up. So always use that. Now if you took this trade right here, you'd redraw your fibs off the last wave. Our new release last night has lines right here that show you. And also notice how many pips are labeled right on the top. 51 pips right now, 44. When I let go, this is automatically going to snap. Notice it finds the profit target. You short right here at 96. Your stop is just a few pips above here at 06. So you're risking 10 pips. In this case, let's say you get short right here at 98. And you get out down here when it hits the fib target at 74. You just made 24 pips while risking 10. That is the kind of risk versus reward that you want to take. Now, if you took this trade right here and it went down and double bottom right here and didn't break the low, you can get out of half and then get out of the second half. Obviously, you didn't make that much on that trade. You always redraw your, and if you got short again right here, you draw your fibs off the previous swing to get an idea of where your profit target is. And in this case, let me reset it. Notice it went to the 1.618. Rarely do they go below that. And the farther down it goes, this is, maybe the first wave, second wave, third wave. This is the fourth wave. At this one, I'm really watching the 1.382. I don't expect it to break it. When it does break it, I'm going to get out usually probably 95% of the time at the 1.618. I'm out. You're short right here at 85. You're out at 56, right? Almost a 30 pip profit while risking 8 to 10 pips. That's the key to trading. So don't worry about your winning percentage. Take the trades. And, once it's gone down too much, you might want to wait for a deeper pullback and wait for a signal there. After it makes 3 or 4 waves down, wait for 50% retracement. This would be the first trade I'd be taking right now. I usually don't trade after 12, so I wouldn't take it for that reason. But now I'm risking 8 or 10 pips. If the trade does work, even if it goes halfway back down, I'm likely to make 1.5 to 2 times more than what my risk is, and it's worth doing.